Do you really know what financial freedom is? Financial freedom is the ultimate goal for most people. It is a position of being able to have enough savings, investments, and other assets to support yourself for the rest of your life without having to work. Another explanation lies in the wellness of your finances. Financial wellness is a holistic term that refers to the state of your finances. In order to be financially well, you must have a good understanding of how you make money, how you spend money, and how you can improve your financial situation. Being financially well is important because it means you are able to live comfortably, pay your bills, and save for the future. With Matador Capital Partners strategies and methodologies, you will discover the paths to financial freedom. Yes, you heard that right. Paths, plural. This is because there are many avenues and directions that can be used to formulate a comprehensive plan that you can follow to attain your goal of financial freedom. Sit back, stay focused, and learn how Matador Capital Partners can assist you in attaining your financial goals. Here is the quote of the century. Be strong, mighty, and resourceful. Always bearing fruit, even in times of drought. Jeremiah 17. 7-9. The Holy Bible. What does the term cash flow really mean? A simple explanation is the real or virtual movement of money. Cash flow refers to your income minus expenses over a set period of time. This term is helpful for both individuals and businesses, as it can clearly indicate what direction finances are heading. Most people will measure their personal cash flow on a monthly basis. What does the term liquidity really mean? A simple explanation is the amount of capital available and how easily it is to exchange or use. Liquidity refers to the ease with which an asset or security can be converted into ready cash without affecting its market price. Cash is the most liquid of assets, while tangible items are less liquid because these items of physical substance may take time to sell before you actually receive the cash. What is an investment? An investment is a monetary asset that is purchased with the idea it will provide income in the future or profit after it is sold. This is an asset or item acquired with the primary goal of generating income or appreciation. Appreciation refers to an increase in the value of an asset over time. When an individual purchases a good as an investment, the intent is not to consume the good, but rather to use it in the future to create wealth. What is the meaning of investing? Investing is the act of allocating resources, usually money, with the expectation of generating an income or profit. Investing means putting your money or other resources towards something you expect to earn income, turn a profit, or create some other positive benefit. When you invest, you buy assets that you expect to increase in value over time, which can grow your amount of money. If you are in need of physical cash, you can dispose of or sell an asset and generate the cash towards your specific need. This is also known as liquidating an asset. What is Wall Street's rule of thumb on investing? One of the most basic principles of investing is to gradually reduce your risk as you get older. That makes sense when you consider that retirees don't have the luxury of waiting, or the capital for that matter, for the market to bounce back after a dip or crash. The dilemma is figuring out exactly how safe you should be relative to the stage of life you're in at any given point in time. For years, a commonly cited rule of thumb has helped simplify asset allocation. According to this principle, individuals should hold a percentage of investments equal to 100 minus their age. So, for a typical 60-year-old, 40% of the portfolio should be equities. The rest should comprise of high-grade bonds, government debt, and other relatively safe assets. Here is a visual example. This rule was established when federal interest rates were 50% to 75%, and income tax brackets were 10% to 20%, but at the time it was targeting the golden recipients who were known as baby boomers. You should remember though that this is just the basic investing guideline, which was conceived in the early 1950s as a portfolio optimization method known as modern portfolio theory, MPT for short. This is also known as the Markowitz model, designed by Harry Markowitz. Over the past 70 years, a lot has transpired and the rules have changed. Life expectancy has steadily risen over the years. In 1950, the average life expectancy was 68 years plus a few months, while 2022 the average life expectancy is 79 years plus a few months, but by 2050, the average life expectancy is estimated at 83 years plus a few months. U.S. Treasury bonds are paying at a fraction of what they did back in the 80s, and even less than they did in the 60s. In 1963, the average yield for the year was 4.00%, with a high of 4.17%. In 2022, the average yield has been 2.70%, with a high of 3.97%. Costs of goods and services have risen dramatically. Not only has gas, food, tax and insurance costs risen, but there is widespread shrinkflation, where products are being reduced in size or quantity, and still being sold at the same rate. Wages have not kept up with the rate of inflation. According to data released by the Economic Policy Institute, the actual value of minimum wage earnings is the lowest it's been in 66 years, when adjusted for inflation and the cost of living. The stock market has been very volatile with extreme ups and downs. In the first half of 2022, the stock market had seen its worst bear market since 1970, and the S&P 500 lost 20% of its value through the end of June, after starting the year at an all-time high. Retirement plans are restricted and uncertain. Financial plans laid out years ago most likely did not compensate for the effects of today's current economy, thus even though you have a retirement plan, it may not be enough to sustain your existing lifestyle and living expenses. The tax regulations around distributions of retirement accounts are stringent. The decisions you make on how you receive your funds may have serious and long-term consequences. Pension plans are becoming extinct. Each and every year, more companies transition from retirement plans to 401k plans. Pension plans are fully funded by the employer, and the funding comes from the company's earnings. By replacing pension plans with 401k, employers are shifting the burden of saving for retirement to employees. This reduces the company's ongoing liabilities and boosts its overall earnings. Even the U.S. military has changed their retirement plan. Soldiers, sailors, airmen, and Marines can now receive some of the same benefits that those who are a part of the Federal Employee Retirement System, FERS, receive in the form of matching TSP contributions. This system is in line with most 401k retirement plans that civilians receive in the workforce. Regardless if you are classified in Generation X, Y or Z, the millennial, pre-retirees, the late bloomers or baby boomer, now is the time to use a different mindset and progressive strategy in adapting to the change. What is the position of your cash flow? The real or virtual movement of money? What are your combined assets really worth? Homes, vehicles, rental property, cryptocurrency, precious metals, tools and/or equipment, land, other physical structures or tangible items. What are your liabilities? Your debt. Mortgages, loans, credit cards, household bills, taxes, anything you are making payments on due to a contract or loan you entered into. Where are your financial investments? Your portfolio. Retirement plans, stocks, savings, life insurance, annuities, pension, bonds, mutual funds, real estate, CDs, etc. Envisioning all of these combined, are you on a course to realize positive cash flow? Let's map it out. Introducing the 4 quadrants of cash flow. Everyone can be categorized according to how they get their money: employee, self-employed, business owner, or investor. Each of these four categories, or quadrants as it's known, has its strengths, weaknesses, and characteristics. There are numerous explanations for the four quadrants, such as employees, self-employed, business owners, and investors, as already stated. Business, management, finance, and valuation. Private equity, private debt, and public debt. Equity, growth, debt, and yield. There are many other variations as well, yet if you research the four-quadrant cash flow models, you will find that they primarily focus on business entities and not on personal or individual wealth. Those cash flow models work well if you are operating a commercial or nonprofit business. What sets us apart from all of the other companies discussing and using cash flow models is that we have developed the four quadrants of wealth model. This model is tailored specifically towards personal enrichment and not focused on business finances. Here is an overview of the successful model that we have developed. Remember that this model specifically focuses on your personal finances. The four quadrants are split vertically in the center, with the left side representing before tax and the right side representing after tax. On the left side you have an upper and lower section, with the upper being before tax and the lower being cash flow and liquidity, CF and L for short. On the right side you also have upper and lower sections, with the upper being after tax and the lower being no tax, also known as the tax-free zone. Now let's take an in-depth look at these, where you can get a comprehensive overview of all the combined facets that are used and how they relate to each specific quadrant. We begin with the upper left quadrant known as before tax, which can also be employer-owned contributions towards your retirement. 85% of employees and entrepreneurs have Wall Street portfolios, but some people may not be aware that their investments fluctuate based upon how Wall Street is performing. This could be very detrimental if the person is relying on this investment for their retirement. 401k and 403b are sponsored employer retirement plans that help you make tax-deferred contributions toward your retirement. The difference between a 401k and 403b is that for-profit companies normally provide 401k retirement plans, whereas 403bs are for nonprofits and certain government agencies. These type of plans have a tax rate of 20% at the time of funds withdrawal or distribution. Pensions are restricted until 59.5 years of age, and most companies have stopped offering pension plans, as stated earlier, and moved to other retirement plans, because it provides the employer a higher bottom dollar, since they don't have to contribute as much towards your retirement. Traditional IRAs have a high-risk, low-return. Should you need to withdraw money from this type of IRA, if you are under 59.5 years of age, then the withdrawal will be included in your taxable income, and you may be subject to an additional 10% tax on this distribution. Thrift Savings Plan, also known as TSP, is a retirement savings and investment plan for federal government employees and uniformed service members. The TSP is a defined contribution plan, meaning that the retirement income you receive from your TSP account will depend on how much money you put into your account during your working years and the earnings accumulated over time. It is good to know that depending upon which TSP fund you have, your actual return can fluctuate based upon stock market volatility. Any type of retirement account that has required minimum distributions, RMDs for short, force you to take withdrawals when you reach 72 years old. The amount you have to withdraw depends upon the specific plan that you are invested into, and you are required to take the withdrawal every year thereafter. This is common with annuities that are owned by a qualified retirement plan. There are no tax consequences if the total amount of term insurance policies does not exceed $50,000. The imputed cost of coverage in excess of $50,000 must be included in income, using the IRS premium table, and are subject to Social Security and Medicare taxes. Because the IRS premium table is used, you could be subjected to excess penalties and fees. The lower left quadrant is targeting cash flow and liquidity. Did you know that only 15% of portfolios have cash flow and liquidity? The primary reason is that people in general don't really know how to harness the returns of their investments. Most just invest with long-term goals in mind, but don't understand that you could actually be receiving a steady income stream from your investments. Tax shelters are legal and can range from investments or investment accounts that provide favorable tax treatment to activities or transactions that lower taxable income through deductions or credits. Common examples of a tax shelter are employer-sponsored 401k retirement plans and municipal bonds. The general summation is that tax shelters are ways individuals and corporations reduce their tax liability. Leveraging your cash value is a strategy of using borrowed money to increase return on an investment. If the return on the total value invested in the intangible item, your own cash plus borrowed funds, is higher than the interest you pay on the borrowed funds, you can make significant profit. While leverage does not change the percentage rate of return, starting with $100 and ending with $115, and starting with $1,000 and ending with $1,150, is still a 15% return in both cases. Generally, life insurance proceeds you receive as a beneficiary due to the death of the insured person aren't included in gross income, and you don't have to report them. However, any interest you receive is taxable, and you should report it as interest received. Guaranteed interest rate means the effective annual rate at which interest accrues on amounts allocated to the guaranteed interest option. Guaranteed interest option means the investment option that pays interest at guaranteed interest rates, set by the investment company from time to time. There are multiple items which could be used for tax-free income under withdrawals. One is a qualified Roth IRA, where withdrawals are federal income tax-free and usually state income tax-free as well. With proper planning, your heirs can take federal income tax-free qualified Roth IRA withdrawals after you die. Another is dual life insurance policy, where you withdraw up to the amount of the total premiums paid into the policy. It is not taxable as it is considered a return of premiums. If, however, you then withdraw any gains on the policy, then these amounts could be taxed as ordinary income. There are other options as well, but we won't get into that right now. What is a risk-free index and does it really exist? The answer to this question is yes, it does exist. The risk-free rate of return is the theoretical rate of return of an investment with zero risk. The risk-free rate represents the interest an investor would expect from an absolutely risk-free investment over a specified period of time. A fixed indexed annuity is a type of annuity that provides a guaranteed interest rate and the potential for growth based on the performance of an underlying index. If the index is positive, then you are credited interest based on your participation in the index. However, when the index is negative, you do not lose money. Your principal is locked in annually and does not directly participate in the stock index. How do you get guaranteed dividends on your investment? This question has been asked so many times, and the answer can be elusive, depending upon the investment market you are referencing, yet we will help try to explain it. The word dividend causes confusion because it is most often used in connection with a public company paying a stock dividend. If you own stock in a public company that pays dividends, you might receive a quarterly check from the company. Stock dividends could also come in the form of additional shares, rather than cash. Dividends represent corporate earnings and are determined by a company's board of directors. Dividend-paying whole life insurance is a type of insurance that you obtain through a mutual company, rather than a stock company. Mutual life insurance companies share their profits with participating policyholders. They do so via dividends. Insurance companies declare their dividends annually, usually around the end of the calendar year. The upper right quadrant is targeting after tax. If you have any government or bank-owned investments, you will have to pay tax on the profits. Sometimes you have to pay taxes based upon an assessed value of the investment. Items such as money market accounts, cannabis investments, and stock market trades through NASDAQ or NYSE are 100% taxable. If you own any cryptocurrency or Bitcoin, Ethereum, and other cryptocurrencies are also taxable. The IRS generally treats gains on cryptocurrency the same way it treats any kind of capital gain. That is, you'll pay ordinary tax rates on short-term capital gains, up to 37% in 2022, depending on your income, for assets held less than a year. The IRS considers cryptocurrency holdings to be property for tax purposes, which means your virtual currency is taxed in the same way as any other assets you own, like stocks or gold. Real estate taxes are a whole different ballgame, as you cannot deduct the losses on a primary residence, nor can you treat it as a capital loss on your taxes. You may be able to do so, however, on investment property or rental property. You will have to pay taxes on any capital gains you earn from the sale of the real estate asset. Almost everything you own and use for personal or investment purposes is a capital asset. Examples include a home, personal use items like household furnishings, and stocks or bonds held as investments. When you sell a capital asset, the difference between the adjusted basis in the asset and the amount you realized from the sale is a capital gain or a capital loss. Gold, silver, and other precious metals are taxed based upon the assessment value, so if the precious metal value goes up in price per ounce, so does your tax liability. If you are an investor who sells gold, silver, and other precious metal exchange-traded funds, you may find the profits taxed at a higher rate than other holdings like stocks and bonds. The IRS treats ETFs backed by physical precious metals as collectibles for tax purposes, according to accountants. Physical holdings in precious metals such as gold, silver, platinum, palladium, and titanium are considered by the Internal Revenue Service, IRS, to be capital assets specifically classified as collectibles. Holdings in these metals, regardless of their form such as bullion coins, bullion bars, rare coinage, or ingots are subject to capital gains tax. The capital gains tax is only owed after the sale of such holdings, and if the holdings were held for more than 1 year. Collectibles like art, antiques, and coins carry a 28% top federal tax rate on long-term capital gains. This is the tax rate on profits for an investment sold after at least a year of ownership. If you're considering an annuity, one of the first questions you'll want to ask is how they are taxed. The answer may surprise you, as annuities can be taxed differently. Some annuities are taxed at the point of sale, while other annuities are taxed at the time that cash is withdrawn. The money some annuities will grow tax deferred, so you will not have to pay taxes on your investment growth until you start withdrawing. This can be a significant advantage, as it allows your money to grow without being taxed yearly. Annuity withdrawal taxes will be taxed as ordinary income. This means you will pay the same tax rate on your withdrawals as you would on any other type of income, such as wages from a job. Life insurance is an essential tool for protecting loved ones against financial loss. But you might not love the idea of making years of payments toward a policy that may never result in a payout. This is good news for you, but not so much for your wallet. Fortunately, one type of life insurance policy takes that possibility off the table. Return of premium, ROP for short, term life insurance refunds, all of the premiums you've paid if you're still alive when the policy term is over. ROP life insurance allows you to get those monthly premiums back if you're still living at the end of the policy period. ROP life insurance can be purchased already integrated into a policy or added as a rider to a regular term life insurance policy, and it's usually more expensive. If you outlive your coverage, 100% of the money you paid in premiums during the term is returned to you, tax-free. However, if you fail to make your The lower right and final quadrant is targeting no tax, also known as the tax-free zone. The reason this is called no tax is because all of the items within this quadrant are wholly owned by you. You may receive dividends on these investments, as well as having tax-free payouts. Some life insurance policies, known as participating policies, pay dividends to their policyholders. Dividends are generally not taxed as income to you. Instead, they are considered a return of your premium, regardless of whether you receive them in cash, use them to purchase additional coverage, use them to reduce future premiums, or leave them invested with the insurance company. Cash value life insurance is a policy that contains a cash value account. This cash value component typically earns interest or other investment gains and grows tax deferred. You have several options if you want a cash value life insurance policy. Each policy type accrues cash value differently, but in all cases, you can get to your cash value through a loan, withdrawal, or surrender. Whole life insurance, also known as WL, is a type of permanent life insurance that's possibly the simplest cash value policy. Whole life insurance policyholders don't have to decide on how the cash value should be invested. The insurance company provides a fixed rate of return to grow the cash value. Universal life insurance policies, commonly known as UL, are the most common cash value life insurance policies. Not all types of universal life build cash value well, so make sure you understand what you're buying if you're looking for cash value growth. Indexed universal life insurance, also known as IUL, allows for the growth of your cash value, as it is connected to gains and losses in an index, such as the S&P 500. With this type of insurance, you can typically adjust premiums and death benefits within certain parameters. When you receive payments from a qualified annuity, those payments are fully taxable as income. That's because no taxes have been paid on that money. But annuities purchased with a Roth IRA or Roth 401k are completely tax-free if certain requirements are met. Convertible insurance lets the policy owner convert a term policy that only covers the insured individual for a predetermined number of years into a policy that covers that individual indefinitely, as long as the policyholder continues to pay the insurance premium. The major advantage of this type of policy is when it is converted into a term life insurance, where the death benefit goes to the beneficiary income tax-free. There are exceptions, such as when the policy names the estate of the deceased as the beneficiary, but the majority of the time life insurance is not taxed. Municipal bonds are federally tax-free and in some cases, are free from state and local taxes too. That means, depending on where you live, you may never owe income taxes on the payments you receive from the bond's issuer, but they may be subject to the alternative minimum tax. When you retire, your portfolio returns might be lower because you're taking less risk, and your healthcare expenses may be higher because you're older. Getting tax-free income may make sense so you can preserve every dollar possible. What is an annuity? The term annuity refers to an insurance contract issued and distributed by financial institutions with the intention of paying out invested funds in a fixed income stream in the future. People invest in or purchase annuities with monthly premiums or lump sum payments. The holding institution issues a stream of payments in the future for a specified period of time or for the remainder of the investor's life. Annuities are mainly used for retirement purposes and help individuals address the risk of outliving their savings. Annuities can begin immediately upon deposit of a lump sum, or they can be structured as deferred benefits. The immediate payment annuity begins dispersing funds immediately after the person deposits a lump sum. Deferred income annuities, on the other hand, don't begin paying out after the initial investment. Instead, the client specifies an age at which they would like to begin receiving payments from the insurance company. Here are just 4 examples of annuity types. Fixed annuity, fixed deferred annuity, FDA for short, fixed indexed annuity, FIA for short, immediate annuity, IA for short. There is a multitude of other types and variations of annuities which may be utilized to provide you with the best available option for your individual scenario and circumstance. The key is choosing the annuity which provides the most comprehensive return on your investment. What is cash value life insurance? Cash value life insurance, CVI, is not a term commonly heard in everyday conversation, but it's a type of life insurance policy that offers protection against loss of income if something happens to you. This is a form of permanent life insurance, lasting for the lifetime of the holder, that features a cash value savings component. The policyholder can use the cash value for many purposes, such as a source of loans or cash, or to pay policy premiums. Some key features of this type of policy are: permanent life insurance policies like whole life or universal life can accumulate cash value over time. Cash value life insurance is more expensive than term life insurance. Unlike term life insurance, cash value insurance policies don't expire after a specific number of years. Policyholders may borrow against a cash value life insurance policy. They may also withdraw cash from the policy, but this will also tend to reduce the death benefit. Cash value insurance is permanent life insurance because it provides coverage for the policyholder's life. Traditionally, cash value life insurance has higher premiums than term life insurance because of the cash value element. Most cash value life insurance policies require a fixed level premium payment, of which a portion is allocated to the cost of insurance and the remaining deposited into a cash value account. The cash value of life insurance earns a modest rate of interest, with taxes deferred on the accumulated earnings. Thus, the cash value of life insurance will increase over time. As the life insurance cash value increases, the insurance company's risk decreases because the accumulated cash value offsets part of the insurer's liability. What is a term insurance policy? A term insurance policy, also known as pure life, is a type of insurance policy that has a specific duration, which is the time that the policy will cover you. Once the policy's duration has expired, the policy will no longer cover you. This type of policy is the simplest, purest form of life insurance, as you pay a premium for a period of time, typically between 10 and 30 years, and if you die during that time, a cash benefit is paid to your family, or anyone else you name as your beneficiary. Term life is typically less expensive than a permanent whole life policy, but unlike permanent life insurance, term policies have no cash value, no payout after the term expires, and no value other than a death benefit. Term insurance is a death and death benefit policy only, so you won't be alive to enjoy it. Here are some key features for a term insurance policy. It can be used to cover burial expenses of the policy owner. Creditors can only garnish the policy payout if it is tied to an estate. If there are no named beneficiaries, then generally the payout on the policy is included in the estate of the policy owner. If the named beneficiaries are still alive, then it is not considered part of an estate. This type of policy has an expiration date, which normally is between 10 and 30 years from the date of inception. There are no living benefits or cash value to this type of policy. We at Matador Capital Partners want to thank you for taking the time to watch this video. Hopefully, the information which we have provided has been informative and educational. If you would like to know how we can help you harness the 4 quadrants of wealth and move you into a better retirement position, feel free to reach out to us via the link in this video's description, as there is a lot more that you will learn.